You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to Watching the Financial Survival Network. I'm Kerry Lutz. Well, markets in turmoil, commodities crashing, instability seems to be the one overriding theme. Let's talk with our good friend at Opimas, Opimas.com, Octavio Marenzi. Octavio, it's great to have you back. So what do you make of this insane world? The wars keep continuing. Maybe more wars on the way, and just nobody can figure out what to do and how to protect your wealth.
Well, it's a very hazardous minefield you have to navigate through to protect your wealth. I've mentioned to you before that I've decided to basically sit on the sidelines and hold on to cash for a bit. Of course, that puts you into a very nasty situation where inflation is eating into your nest egg. But it's better to lose 10% to inflation than lose 30% on the market or lose 25% in the bonds or whatever else you can do. So for the time being, that's the strategy we're pursuing, is basically say we're going to wait for a while and take it easy and just take the hit basically on the inflation. And when I say sitting in cash, I really mean cash as opposed to sitting in bonds, because bonds, of course, have an interest rate component to them too. And they fluctuate, and bonds have been hit really hard this time around as well. So there's been no place to hide. Be it bonds, equities, crypto, gold, nothing's doing well, except for the dollar, I guess. The dollar's doing very well the past few weeks.
Yeah, relative to all the other disasters in the world here, Octavio. Look, if you're losing 10, 15% a year in inflation, maybe you're better off just taking your money and going to the casino where you might win a lot, because you're going to lose it all anyway, right?
You might, yes, put everything on red at the roulette table and see what happens.
I think your odds are better than in the stock market right now, right?
I'm not sure. I'm not sure. I think the odds in roulette might actually be a bit better overall. I mean, I was looking at things in foreign stock markets now, and the FTSE 100 in the UK is basically now at the same level it was 22 years ago. So around about 2000. So if you'd invested at the wrong time, right at the peak of the market in 2000, at the dot-com bubble, your returns would be zero over 22 years. Now, they say you should invest in equities and think about the long term, but more than 22 years is very, very, very long term. You would have been better off just keeping the money under your pillow at home and sleeping that way.
Now, there's a thought. Well, one thing, though, we do know is that the market in the past, unless this time really is different, the market always recovers and generally goes to newer highs. The one thing that people say on the way up, this is a new era. It's different. This time's different. Bitcoin's different. Technology's different. We've never experienced anything like it. But on the way down, they really believe that this time is different, that the market will never recover again. And then you zig when you should zag, and you zag when you should zig. So should we believe, Octavio, that this decline, this bear market, is different than all the rest that came before it? Hundreds of years.
No, I mean, you're absolutely right. I mean, there's been, at least in the US, that's true. Like I pointed out in the UK, that hasn't necessarily been true. So you can look at long periods of time where that hasn't worked out. I mean, if you were a Japanese investor and invested at the height of the Japanese bull market and were unfortunate enough to invest in about October 1989, whatever the exact date is, I don't know, you would have still not recovered your money from then. You would still be sitting on enormous losses. So it's certainly true in general. Certainly US markets have always recovered. But I think there's a thing to watch for in terms of the signal. And I think the signal is going to be that the Fed basically capitulates at some stage and says, we've raised interest rates far enough now. We're going to start lowering them again, and we're going to pump more money into the economy because we have to do that. And that will be, I think, the signal that the market will start to rebound. So that's really what I'm waiting for from my end, is waiting for the Fed to decisively say, we've had enough of this monetary tightening now. We're going to open the monetary spigots again, and that's going to drive asset prices higher. I don't see that happening before the Fed does that. So we're sort of in a holding pattern until that happens. And I can't tell you how long that will take. I mean, I could see them doing that again by the end of the year, or 6 months to 9 months. I don't know. I don't know what goes on inside Jay Powell's head or at the Fed's board of governors. But I think that's the deciding factor in this market, is what the Fed decides to do and when they decide to abandon this monetary tightening policy they're on right now.
That is a great point. And look, Jay Powell is really playing a poker game here. He's got a bad hand that's been dealt, but he's bluffing all the way to that final card, hoping that he's going to get a hand when he has no hand. And just like every poker player, they all have tells, even the best ones. They do their best to conceal it. What is Jay Powell's tell that you're going to know before the rest of the market that this guy, is folding his hand, if you will?
Well, that's a really good question. And I think all you can really do is sort of watch his pronouncements and statements and what he's saying, and how he sort of hedges to things. Because there's, of course, the one factor is, what is the overnight interest rate that they set for the Fed fund rates, and what are the purchases and open purchase and sales they make through the Federal Open Markets Committee. And so those are things obviously to watch in terms of the numbers. But I think you need to have a leading indicator, because that's kind of a lagging indicator. By the time you see that, it's already happened. So you want to know beforehand. And I think there you can just sort of look and read between the lines and nuance of what he's saying. Unfortunately, it's not terribly clear. I mean, I don't know if you saw recently, he just said that we've been caught off guard by this inflation, and we're just realizing how little we know about inflation. And I'm thinking, really? I mean, I think economists have been looking at inflation for several hundred years now, and they understand, even longer, back to the Romans, they understood that if you debased the currency, you had inflation, right? If you mixed in some bronze into the gold coins lost value. They knew that pretty well. If you increase the money supply that way, you have inflation. And that's been known for a long time. So I'm so very surprised to hear that he feels he doesn't know much about inflation or what's driving it. Maybe he's just trying to play stupid. It's kind of a disingenuous comment by him. But I don't know. But I think that's the kind of thing you have to watch, is exactly what are they saying and thinking, and then extrapolate from that. And that's a hard thing to do, because central bankers tend to have a tendency to speak in sort of a very peculiar language that is very hard to interpret and understand. And I think the absolute master of that or the mistress of it, is Christine Lagarde at the European Central Bank, where I listen to her, I have no idea what she's saying. I have no idea what she says or what she means in terms of her statements. But I think it's clear there she's going to start to increase interest rates slowly at some stage in the not too distant future.
Hey, well, remember the good old days of Alan Greenspan. You never knew exactly what the hell he was talking about, but you sure did feel good when he was saying it. These guys, you don't feel good about anything they have to say. There's no upside. Hey, so look at commodities now. They're kind of crashing. My gut feel is that this is an intermediate kind of decline, probably short-lived. But how much lower can gold go? Silver? I mean, silver under $20. That's kind of shocking, isn't it?
Yeah, gold's had a really rough run the past few days, but I think you're right. This is sort of an intermediary plateau, because I think the fundamental issues and problems have not changed. And the fundamental problems are that central banks around the world have just pumped a huge amount of money into the markets. And of course, that's going to drive inflation. It's going to drive prices high of all asset classes. So they haven't fundamentally drained that liquidity out of the markets, but I think there might be some expectations that they will do so in the future. So the Fed sounds like it's moving in that direction. The ECB in Europe has made noises in that direction. The Bank of Japan doesn't care. They're going to print to the very end. They're just going to carry on printing, so they're not too worried and concerned about it. But so I think the market is now saying, okay, the central bankers around the world have this under control, and therefore likely commodity prices will fall. So I think that's basically based on traders' expectations about inflation in the future and interest rates, and that the central banks are taking this very seriously now and will turn it around. I think they're likely to be disappointed. We don't see a follow-up really strong action in terms of tightening the money supply and increasing interest rates quite severely. I don't think we'll see that inflation come down, and I think we'll sort of start to pick up again. So I think I agree with you 100%, Kerry. I think we're kind of a boring interview, you and I, because we agree on so many things that we need to get someone on board who disagrees violently. But no, I think I'm with you there. I think there's a plateau. We're going to see it come down a bit, and then there'll be disappointment or realization that the central banks are not going to follow through that aggressively with interest rate hikes, and then we'll see inflation rip and roar again in the not too distant future.
And if we go back to Greenspan, everybody talks about 20+% interest rates in the U.S. here. But the other thing you did was cut credit. Credit cards were cut back. Credit limits were cut back. And that credit creation combined with the interest rates really did take the wind out of the sails of inflation. Whereas here, for Jay Powell to say he doesn't understand inflation is absurd. The guy probably went to Harvard or Yale or someplace. Maybe he cut class the day they talked about inflation, so he missed out on it.
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network. The information you need to thrive. Now more than ever.
It's possible they didn't mention it and they didn't really explain it. And inflation is sort of described, I think, by many macroeconomists at these Ivy League schools as some sort of extraneous factor that's sort of part of a landscape and central banks have no real control of it. I'm not sure. I think that's what it seemed like to me, that they don't really have a good handle on that. I think they never talk about really the demand and supply for money. They might talk about the supply of money, but you never hear them talking about the demand for money. Of course, those two things are what decides what the value of money is going to be, and they just don't talk about it.
So true. I mean, to proclaim ignorance at this point here, it's not like inflation. We get these waves, and they happen every 40 years. It's like clockwork. I mean, you just have to go back from 1970 to 1940 to 1910. And they often coincide with a war cycle as well, because wars are inherently inflationary. But, they've been sucked into this modern monetary theory, and they seem destined to run it out to the end.
Listen, I think you should get one of these modern monetary theorists on your show and have like an open discussion with them, because to me, they sound insane. They just sound to me like they've taken absolute leave of the senses. But I'd love to have someone like you sit one of them down and say, well, let's talk about this and understand what you really believe, because the whole basis of their theories sound to me so wacky that and they seem to be sort of running the show at the moment, or at least people heavily influenced by them. So it's kind of a scary thing to see.
And no matter what program, what idea, no matter how off the wall it might be and how unfeasible it is, they still say, well, let's try it. Whether it's all the stimmies that got passed out around the world during the pandemic, whatever it is, there's zero restraint on government, on fiscal policy, and because the monetary policy facilitates runaway fiscal policy. Whatever it is they want to do, they can just do it. And there's no market constraint. We used to have those guys called the bond vigilantes. They look like they might have come out of their somnambulant state currently, but they were supposed to keep the whole process honest, and it seems like they went on strike.
Well, I tell you, I mean, if you take a very long-term perspective, we have seen, of course, an enormous amount of expansion of the money supply since the US went off the gold standard, and even before that, because it was really wasn't the gold standard. I mean, there wasn't really strict convertibility of the dollar into gold. It was sort of a gold standard-ish when Nixon went off it finally. And since that, we've seen an enormous increase in the money supply. We've seen an increase in prices and inflation as well, but not nearly as much as you might have expected given the expansion of the money supply. So there was something restraining that kind of price inflation. And I think what it really was two things. First of all, we had the opening up of China. And just manufacturing lots of cheap stuff. And that should have been deflationary. That should have pushed prices down, and did. It kept prices in check because you could now buy a whole bunch of stuff at much lower prices than you could otherwise. And the other thing is basically the whole sort of computer evolution, information services, information technology over the course of the past 30, 40 years. That should have and did lead to a big increase in productivity, which is deflationary in its own way. So that pushes down prices because you can produce more stuff at a lower cost. And nevertheless, we saw prices sort of go up 2-3% every year, despite those very strong deflationary pressures. And that's just because the Fed was printing that much money to make up the difference. Now, things might be different in the sense that I think the whole China story has run its course. We're not going to get a big discount in prices anymore moving forward from China. And I think maybe the efficiency gains that we saw from information technology being adopted over the course of the past 20, 30 years, computers in general, have maybe also run its course. And so those two things kept prices down despite the big expansion of the money supply. So maybe the Fed is not going to be able to keep interest rates as low anymore without stoking inflationary pressures. So we might be getting to the stage where really low interest rates, the way we've seen the past 5 or 10 or 15 years, are a thing of the past. And we're going to have to simply live with 10% interest rates going forward. That's just going to be the thing.
Yeah, well, one thing we do know, Octavio, is that when these inflationary waves start, they're very hard to suppress. They become more or less intractable because inflationary expectations get built into the system, both at the consumer level, at the business level, and basically people just want to trade their cash for items that they believe will hold value or be more useful. Hey, one thing I'd like to point out, though, maybe, the U.S. has always been accused of exporting inflation, and it seems to be pretty good at it. Well, now the Chinese yuan is under pressure, and maybe we'll see a 20% decline in the yuan, which will be a countervailing inflationary pressure.
Indeed. Well, listen, I'm not sure how it's all going to play out. I don't know. I can just say I think for me the safest bet right now is to do nothing and withdraw from the markets and sit on my hands idly for some time and wait to jump in. And I'm watching, reading between the tea leaves for the Fed meetings and interviews that central bankers give around the world for the signal that they're about to start buying again. So that's my approach. But it's a very treacherous market. There seems to be no good, clear strategy to pursue right now.
Even kleptocurrencies have taken the hit. Bitcoin has really found support at its 2017 high, right around 20,000, but it's looking very weak. The chart is awful. It's down over 2/3 from its high. So maybe a little allocation into roulette isn't such a bad idea, Octavio.
Could be. I mean, the housing market is looking a bit shaky, I must say as well. That's another thing. I think that's the next shoe to drop. We haven't seen declines in prices really yet, but I think that's about to come. That seems to be the direction there. And that goes back to the Fed as well, who has plowed an enormous amount of money into the mortgage markets and bought up all the mortgage-backed securities they could find. And that has had a huge impact in terms of supporting housing prices. I don't quite get it because it seems at some stage in 2020, at the height of the COVID or the beginnings of COVID, someone at the Fed sat down and said, it'd be a really good idea if we could drive up housing prices now. That would be really beneficial for the market and for the economy and for the American citizen. That would be the thing to do. And that's what they went out and did. They bought trillions of dollars worth of mortgage-backed securities and drove housing prices up. Now, I don't know why they think it's a good idea, but someone there thought that was the thing to do.
Well, they could have been cutting back on those mortgage-backed securities purchases over the past 10 years once housing rebounded in roughly 2014, 2015. Different times, different places in the country, obviously. They should have been looking for an exit plan, and instead they doubled down. The other thing is, What if we went back to 2021, where everything kind of reopened and started with a 25 basis point rate increase every other month? Things might have been a little bit different. They wouldn't be playing catch up now. And, Greenspan always said it was the job of the Fed to pull away the punch bowl when things got too out of hand. And instead, this Fed was refilling the punch bowl when they should have been emptying it.
Yeah, Alan Greenspan also said that he was a fervent supporter of the gold standard, and he thought that going off the gold standard was theft by the government of people's assets. And he stood by those comments. So he wrote that when he was a young man in sort of a fervent belief as a free marketeer. But later on in his career, he also stood by that and said, yes, that's absolutely right. Going off the gold standard was just theft of people's money.
That was doing it during his Ayn Rand days. And how things change when you become head of the Fed. Hey, I guess we'll leave it at that. So people want to contact you, find out more about what you're doing, Octavio, best place to go?
Is our website, opimas.com. That's opimas.com.
All right. And there's a link to it in the show notes to this interview on financialsurvivalnetwork.com. Make sure you go and sign up for our free newsletter. By the way, you can always send any questions to me, kl@kerrylutz.com. We'll get you an answer from Octavio. Octavio, we'll talk to you again and see how this soap opera unfolds.
Thanks so much.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.